So, hi everybody, this is Asahab and Giacomo, and today I'm again with Jordan Lambert. He's a CFA Chartered Managing Director of ConvEquity. And today we're going to cover CloudFlare after the earnings report that came out last week. This is a continuation of the first analysis we did last week. Last week was a qualitative analysis. This is a more quantitative analysis. So make sure to check out the previous video. The link will be in the description. And check out the whole cybersecurity playlist I did with Jordan from ConvEquity, and subscribe for the new videos to come in the cybersecurity space. So without any further, Jordan, introduce yourself and let's get into the content.
Thank you, Giacomo. Thank you for having me back on to do a quick review of CloudFlare's quarterly earnings result released last Thursday. So let's just this quick disclaimer for viewers here. Right, so this is the share price of CloudFlare. We can see that after CloudFlare released its earnings last Thursday, it was after the market closed on Thursday, in after hours and following Friday, the share price gapped down quite sharply from about $58 down to the low 40s. So in this presentation, we're just going to discuss why it gapped down, what were the disappointments for investors, and we're going to consider the near-term investor considerations and also longer-term what investors should be thinking about, and also what investors should be thinking about in the next few quarters as well. So just CloudFlare at a glance, we just nicked this slide from CloudFlare's investor presentation. So in the first quarter of 2023, revenue came in at $290 million. And that was a 37% year-on-year increase compared to the first quarter of 2022. Now, this wasn't a disappointment. This was pretty much in line with expectations. It only missed by about $800,000. But the issue is the guidance that we'll come on to in a couple of slides. So a big reason why CloudFlare has moved their guidance lower is because they are not increasing the number of large customers at the rate that they were in previous quarters. So we can see here since 2020, the first quarter of 2020, the compounded average growth rate in the number of customers has been 57%. However, year on year, the growth in large customers in the first quarter of 2023 was 40%. And that's been coming down quite sharply in the last few quarters. Now, 40% growth in large customers is good, but it's quite a deceleration. Paying customers has also been decelerating as well. So the growth in the number of paying customers, but not as severely. And this kind of slowdown in the number of large customers and what those large customers are spending has impacted CloudFlare's dollar-based net retention. So just to explain what dollar-based net retention is, the calculation is slightly different across different software companies, but CloudFlare calculates it as a bunch of customers that were customers 4 quarters ago. What were they spending, and then fast forward 4 quarters to the present day, what has been the increase in spend from those customers compared to 4 quarters ago? And the increase in spend has been in the 20% mark, as you can see here. It's always been like mid to high 20% increase. But there's in the first quarter of 2023, there's been a sharp drop in that. And this is because the large customers have been slowing down their spend or the expansion of their budgets. And also the number of large customers has been decelerating as well. So here are some just very few highlights, financial highlights from the earnings call. So the first quarter revenue was 290 million, which is a 37% year-on-year increase. That was slightly below expectations, but that's not why the stock actually gapped down. The non-GAAP earnings before interest and tax was 19 million, generating a 7% margin, and this was slightly higher than the prior guidance. The thing that's really surprised investors to the downside is the guidance. So for next quarter's guidance equates to only a 30% year-on-year growth, and for the full year, CloudFlare is expecting growth of 31.5%, which is quite a drop in guidance compared to the guidance that they gave in the fourth quarter of 2022 at the end of the fiscal year 2022, whereby they guided for 1.3 billion of revenue for 2023, and that now they've lowered that guidance by 54 million. So this is what's upsetting investors. But 3 months ago, very, very optimistic, saying that 2023 is going to be a year of 37% revenue growth, and now 3 months later, they are lowering that down to 31%. We're going to get onto some more implications about what this means in the coming quarters for investors, but firstly, we'll just discuss some of the non-financial highlights. So, a lengthening of the sales cycle caused by uncertainty arising from the Silicon Valley Bank collapse has impacted CloudFlare. So CloudFlare has a lot of startups that have been impacted by the SVB collapse, but also just the general rise in uncertainty that the Silicon Valley Bank collapse and the general kind of slow burning contagion that appears to be happening. It's just raised a lot of uncertainty, and therefore these enterprise customers also are not being as decisive and extending the sales cycle. Matthew Prince has criticized a large portion of his sales organization for underperforming. So he actually mentioned around 100 members of its sales organization had seriously underperformed. These collectively, this 100 member group of sales organization has only contributed 4% of revenue for the company. So they really are underperforming. We don't know if it's actually those individuals underperforming, or is it because of this new top-down go-to-market strategy that isn't highly optimized and efficient? So we'll talk a bit more about that in the next slide. So they are two negatives, but some positives coming out of the earnings call are that there are now nearly 5 million workers applications running on the workers platform. And this is an increase of 146% in the last 6 months. So that's quite spectacular. Now there's also 33,000 paying customers that have activated R2, which is the object storage facility that provides developer teams with an alternative to using AWS's S3 object storage. And that's the activity there has increased 25% sequentially quarter on quarter. So that's huge as well. So with all these thoughts in mind,
Jordan, I would also add that if viewers want to get a better understanding of the underlying service that you're talking about, they can find the description in the description, a very thorough analysis in the first video.
Yeah, thank you, Giacomo. Yeah, thanks for reminding that. So yeah, we won't go into the details of any of CloudFlare's products, but we did do that in the first video. So kind of bringing all these highlights, financial, non-financial highlights together, kind of compelled me to put together this slide. Again, a very, very basic slide, but I think it just illustrates what's happening with CloudFlare right now. So CloudFlare, they get a thumbs up for their bottom-up go-to-market strategy because that is in their DNA. They've been doing this, offering free services to developers and small, medium-sized businesses. You know, offering like free service for the first 50 users, or offering free credit for so much consumption. Since they began as a company. And that's why we've got probably around 5 million users in total, including free and paying. Now, this has been very, very successful because a lot of these developers, small teams, they eventually become paying customers and grow with the company. Still very, very successful, which is evident by the 5 million applications running on Workers and the now 7 petabytes of data being stored in R2, which is huge. So evidently the bottom-up strategy is still working, but the bottom-up strategy is really geared towards website protection, website performance, and edge compute and storage. However, the top-down go-to-market strategy is rather new to CloudFlare, and this is why Matthew Prince acutely is aware of the changes that CloudFlare needs to make in order to be as good at the top-down stuff as they are at the bottom-up stuff. And this is why he recruited Mark Boroditsky to become president of revenue late last year. And his job was to create a high-performance sales organization that is adept at, high-touch engagement with C-level executives, and also with the channel partners as well, and in order to become better at sales and marketing and land some large deals with large enterprises, mainly for network security. So that was the plan. And clearly 3 months ago, when in the fourth quarter of 2022 earnings review, Matthew Prince was very, very confident. Speaking very, very confident about the new strategy, who they've appointed, and the pipeline, and just very, very optimistic overall. However, clearly there's something not quite right with this go-to-market strategy, because he's blaming 100 members of a sales organization for underperforming. It might not be them directly. It might be maybe some teething issues with what Mark Boroditsky has implemented at CloudFlare. And this is ultimately the underperformance in this new top-down go-to-market strategy is what has led to a drop in the growth in the number of large customers, or customers becoming large customers, and also the drop in the net dollar retention rate. So basically larger customers are not increasing their spending by as much, and that's what's impacted. It's what's impacted the guidance going forward. So this you can basically summarize CloudFlare's first quarter 2023 results by this: bottom up still good, top down is a long way to go. So here we're just going to have a look at the operating model. So you can see that over time, the operating expense as percentage of revenue has been coming down. And it's interesting to look at this, because if CloudFlare's revenue growth is decelerating over the next few quarters, then if management want the stock to recover, then they need to squeeze out high margins, because that's just the climate that we're in right now. People are wanting profits over growth. So really, they do need to be eking out more margins. Personally, I think it's going to be really difficult for CloudFlare to do that, mainly because, as we've just been talking about, they've recently launched this new top-down go-to-market strategy, high-touch engagement with C-level executives and channel partners. partners, and it costs a lot to implement any new marketing strategy, especially if it's a top-down one. So it's hard to envisage that the sales and marketing as a percentage of revenue is going to drop below what it is right now. If anything, it might even need to go up a little bit higher, especially if CloudFlare needs to do some reorganization already to compensate for the underperformance of those 100 members. So that's interesting. And also, where can we squeeze out more margins? Well, not probably many other places, because gross margin is around 76%, and Cloudflare's global network is running pretty optimally. I wouldn't say there's lots of margin that can be squeezed out higher up the income statement. So as I say, at the operating level, I think the margins it probably go a little bit higher, but not a lot higher like some of the other software companies have done. And also, Cloudflare isn't laying off anyone, which is a positive and a negative, right? Because we've seen Okta, Meta, other software firms have done some layoffs, 5%, 10%, and it's really helped boost the stock because they've been able to increase the margins. But Cloudflare isn't doing that. So it shows that they believe in the pipeline and the opportunity ahead, because they're not doing any layoffs. They're actually recruiting more salespeople. So they truly believe in what they see ahead. So that's going to be an interesting dynamic. Will investors not like that, or will they like it? It depends how short term you are as an investor. Short term, probably bad, and it could push the stock further down after it's already gapped down. But if there's more long term oriented investors, they might be able to think, right, well, if they're really committed by not laying off and actually adding more people, then they're in a better position than many other software firms. Right, so let's just take a look at the trajectory of the margins. So we've got EBIT margin, the non-GAAP EBIT margin, and the free cash flow margin. And it has risen, they've all risen from deeply negative territory towards break even. Recently, the EBIT margin has plateaued out. But as I say, it's going to be difficult to see this trajectory continue because of the sales and marketing expense required. And also with the free cash flow margin, there's also the CapEx to consider as well. Cloudflare historically has been spending around 13% of its revenue on CapEx, expanding its globally dense network. And this is a lot higher than other companies with a similar data center strategy, like Zscaler and Fortinet. They have this co-location data center strategy where they partner with someone like Equinix rather than the public cloud providers. But even then, Zscaler and Fortinet only spend around 6 or 7% of their revenue on CapEx, where Cloudflare has been spending 13%, and the guidance is going forward is between 11 and 13%. So if CapEx remains elevated, then it's going to be difficult to see free cash flow margin go much higher from here. So this is why I think, in terms of operating efficiencies, I think we might disappoint slightly disappoint. So let's move on to this. Right, we spoke about the gap down earlier. What caused the gap down was the drop in guidance for 2023. And this is what we're unsure about, is the repricing by investors based purely on the lower guidance given for the remainder of 2023. Personally, I think it is just based on that. However, in the call, management didn't discuss the longer term guidance. The longer term guidance that was given previously in the fourth quarter of 2022, that guidance was for growth of 39%, compounded annual growth rate of 39% over the next 5 years through to the end of 2027. So CloudFlare would surpass $5 billion in revenue. Now, in the first quarter, in the most recent earnings call, that wasn't discussed at all. So, and my theory is that management, if they did want to lower the long-term guidance, they didn't want to disclose that in this call because they didn't want to give too much bad news to investors all at once. And this is what we've seen this a few times, like software companies, leading software firms like Okta is one that springs to mind. These companies have had to lower down their full year guidance as they've seen a deterioration in their business. But they don't lower the long-term guidance straight away. It might take them a few quarters until they lower the long-term guidance. And that is because we don't want to give investors all bad news all at once. They want to stagger the bad news. So it could be the case. It could be the case that, in a few quarters, Matthew Prince announces that, that long-term guidance of 39% growth through to 2027, we're lowering that down now. We're not going to reach 5 billion. And they might either just remove the guidance or lower it down. And if they do that, then the stock could continue to tear down. So that is a key point that investors need to watch out for in the next few quarters. What are they doing with that long-term guidance? Are they sticking to it, or are they going to discontinue it, remove it? But who knows? With the continued recruitment of sales people for the new go-to-market strategy, and CloudFlare, one of few software firms that are not laying off, then that might be an indication that they do still think that they can grow 39% through to 2027. Who knows? So these are some thoughts we've had in order to revalue the stock. Before we go into the DCF valuation, here is just a scatter plot chart with a line of best fit. On the x-axis, we've got estimated next 12-month revenue growth. On the y-axis is the last 12 months enterprise value to gross profit. The stocks above that line are relatively overvalued. The ones on the line are relatively fairly valued, and the ones under the line are undervalued. So we can still see, even after the drop in enterprise value to sales, like we can go here. So enterprise value to sales for CloudFlare dropped from about 20x to below 14x, and EV to gross profit margin dropped from high 20s down to 18. So even despite these drops in multiples following the gap down, CloudFlare is still relatively overvalued compared to a bunch of peers. There's about 40 peers here. So this would indicate that there might be some further downward path to go. Usually after a gap down, you would see the stock maybe doing a bit of sideways motion, but going down a little bit further. Especially would do if investors start to believe that CloudFlare is not going to be able to reignite the growth in accordance with the prior long-term guidance. Right, so here is the DCF valuation model. We try and keep it very, very simple. The main parameters are the revenue growth and the free cash flow margin. So prior, the intrinsic value per share, we had it around $52. And this was because the revenue growth in 2023, based on management's guidance, was higher. It was at 37%. And after that, we kind of just decelerated growth gradually. We didn't keep it at the 39% CAGR that was given in the fourth quarter 2022 earnings. But nonetheless, we've changed it to the current guidance, and instead of reigniting growth in 2024, 2025, we've just, for conservative reasons, just declined it all the way down throughout the 15-year forecast period to the 3% sustainable growth rate, which we are saying is generally the average growth rate of a software firm. It's a bit higher than the economic average, which in the US is probably much closer to 2%. But anyway, and the free cash flow margin is the other key parameter. So for the full year 2023, we were just saying that free cash flow margin is going to be about flat, but we think over time free cash flow margin will increase. And viewers are welcome to click the link and copy and paste this and put it into their own spreadsheet and play around with parameters. But
yeah, the link of the DCF will be in the description as well.
Yeah, thank you, Giacomo. What we do here is put the rule of 40 as an anchor for these projections, just to just as a check, just to see that it is reasonable. Right, so the rule of 40, the reason why the rule of 40 came about is because it was not acknowledged or recognized by somebody that leading software firms tend to have a good blend of growth and free cash flow margin. And if you add those together, the growth and free cash flow margin together, often leading software firms have it around 40. But CloudFlare hasn't, even during the good times, hasn't been an elite rule of 40 metric. There's some like Fortinet and Palo Alto Networks, Palantir. I know they're not specifically cybersecurity, but many of these companies have a rule of 40, which is actually a rule of 70. A great blend of high free cash flow and good growth. CloudFlare isn't in that bracket. They're usually in the 40 range, between 40 and 50. So going forward in the next few years, there is a bit of trouble for CloudFlare. We're just saying, right, okay, well, it's not going to go much higher than 40. Let's just to be conservative, but it will be around 35 to 40. So I think that's a good check to make, that we're not being too optimistic. If this rule of 40 was towards 50, then we'd have to recalibrate the revenue growth projections or free cash flow margin. Well, CloudFlare is a leading software company. You would expect them to balance the rule of 40 between 30 and 40 quite comfortably. And we won't go into much of the details, but because I presume most of you viewers know how DCF valuation works, but after updating all the numbers and making adjustments from the equity enterprise value, making the adjustments to get the equity value, adjusting for debt, non-operating assets, employee options, RSUs, etc., and then dividing by the adjusted number of outstanding shares, which we calculate to be 104 million shares, we arrive at an intrinsic value per share, including stock-based compensation as a cash expense, is $43, which is about what the stock is right now. Which is interesting because earlier I did mention that it doesn't look like investors are pricing in any future lowering of the long-term guidance, right? So yeah, but here I have factored that in. So small discrepancy there. As I say, you've got to take these DCF valuations with a pinch of salt. They're not an exact science. There's quite a few parameters involved and a lot of subjectivity. So, but we would say CloudFlare is it might be in the fair value range right now, but we would advise viewers just to be cautious. If you are an investor of CloudFlare or thinking about investing in CloudFlare, just be mindful that further bad news may come, because if they, in the next quarter, if they decide to lower that long-term guidance and, instead of in 2027, revenue being 5 billion, if it is more in line with kind of 4 billion, or maybe, if I'm honest, they'll just remove the long-term guidance. They won't actually give an updated one. They'll probably most likely just remove it. If they do that, then that would be bad for the stock, and you could see it declining further. So yeah, there's that, but the positives are that CloudFlare isn't laying off anyone. They're actually recruiting more people. It kind of gives confidence in Matthew Prince's vision on what can be achieved with the new top-down go-to-market strategy, especially in the network security. But the other downside is it's difficult to see where higher margins are going to come from. That's not to say that margins aren't, I'm sure they'll be able to squeeze out higher margins, but it's not going to be at a rapid rate like compared to some other software companies that have really managed to gain operating efficiencies and increase their margins by quite a delta. I don't think that will happen with CloudFlare. So some food for thought there for your viewers who are interested in CloudFlare.
Okay. So I have a few questions. Do you think this slowdown in projections is something that we can expect across the board in this sector, or is this just something that is going to hit CloudFlare in a specific, or the other companies with this specific go-to-market strategy?
Yeah, that's a good question. I think CloudFlare are one of the last to lower their guidance. While many companies, software companies, deep into last year began lowering their guidance, CloudFlare has kept their guidance quite high, relatively speaking. Slow deceleration, but been quite optimistic right until the end of 2022, when I say they're forecasting 37% growth for 2023 and 39% average growth through to 2027. Now they've changed their tune, which is interesting because CloudFlare usually, because of their business model, they do have insights that some other software companies don't. But I think Matthew Prince was really pinning his hopes on the new go-to-market strategy. You could tell by his tone in the previous earnings call, and it's not transpired to how he hoped. So that's why he's being forced to lower the guidance. I think to answer your question, it's already happened. A lot of software companies have already lowered the guidance, but not a lot of cybersecurity companies, right? So we may see Zscaler that reports in, I think it's 1st of June. Don't quote me on that. They may lower their guidance, and we might see some other cybersecurity firms follow suit as well. But generally, yeah, guidance. It's not specific to CloudFlare. Generally, guidance is coming down.
Okay. And probably the change in go-to-market strategy is taking more time than expected. So he was hoping for something better. Okay. Another question that I have is more about the cost of capital, maybe not directly to this valuation, but how the cost of capital as a whole is affecting CloudFlare. Given the fact that it has a bottom-up strategy, it's probably hitting harder the customers that CloudFlare used to work with, right?
Yeah.
Could we see a stronger growth in CloudFlare if the cost of capital situation were to change, or can you see something like better than expected growth if the cost of capital were to change the other way around, and the customers that CloudFlare has were to have a better financial situation?
Right. Yeah, that's a good question. Well, the cost of capital can be affected a number of ways. Generally, you can see that we put estimate the cost of capital for CloudFlare to be about 11%. Just to give you a bit of context, we used to go deep into the intricacies of calculating the cost of equity, cost of debt, equity risk premium, interest rate trajectories. But there's a lot of subjectivity in all of those parameters that you need to estimate. So I kind of just came to the conclusion that, right, on average, companies, their WACC, a big percentage of their WACC companies, their WACC are between 8 and 11%. So we've started Cloudflare's WACC in this model at 11%, as you can see here, and trail it down to the end of the period by 7.5%. The WACC, the true weighted average cost of capital, could change as Cloudflare gets bigger, obviously. As it takes on more debt, that would lower the cost of capital, and it has begun raising money via convertible debt. But if it continues to do that bigger amounts, then that could lower the weighted average cost of capital, and also more diversification as well. And I think even though they do have a huge amount of diversification in their customer base, I suppose they don't have a lot of diversification in terms of revenue. Most of their revenue is coming from small to medium-sized businesses. Well, that's not exactly true, but a lot of them is coming from the edge compute and storage side, and the kind of web acceleration, web protection side. And as they go deeper into expand more into network security and get more and more large customers that have more stable spending patterns, and also more geographic diversification. So generally, revenues diversifying across products, across customer types and geography, then yes, the stock could become less volatile, and then that could translate into a lower weighted average cost of capital through a lower cost of equity, right? So yeah, I think over time, and I think this is why we build it this way, this model this way, is to start off with a higher WACC and then over time decline it, because as they get bigger and more diversified in all those different angles just mentioned, it will likely come down. But yeah, as I say, this model's kind of already factored that in.
Okay. So probably for the short term, you think that companies that have a greater share of large companies as customers are better positioned than those that have a greater amount of small to medium-sized companies as their customer base, right?
Absolutely,
because they are the ones that are more affected by the changing cost of capital.
Yeah, absolutely. Yeah. So so from that angle as well, so the rising cost because of the rising interest rates, that's going to impact the smaller companies more so than the enterprises, right? So I think it's fair to say that. I would say so.
Okay. So you think like companies like Palo Alto and so on that have as a percentage of their customer base, larger companies are better positioned for the short term. But I always want to mention that you are very you are very positive on the underlying technology that Cloudflare has for the long term.
Yeah, right? Absolutely. Yeah. So viewers can obviously go to the first presentation, but Cloudflare has a great chance of being the only viable alternative to the hyperscalers, which are AWS, Microsoft Azure, and Google's GCP cloud. They can do the computing, the storage, the networking, and the security. And over time they're only going to mature what they can do in that realm. So that's a big part. That's at a high level. That is the thesis. And also growing into the enterprise network security with more success with their go-to-market. I think it's just a matter of time as well. And when they have proven themselves in the enterprise segment of network security, and they've got a bigger customer base, then opportunities in the government will open up as well. That's one thing that Zscaler has a big advantage over Cloudflare is they have the FedRAMP authorization of a high level. Cloudflare has moderate FedRAMP authorization. So Zscaler amongst network security players have the highest FedRAMP authorization. That's why they get a lot of government business. And generally that's what, because government tend to go for more established solutions, whereas Cloudflare is only just recently entered into enterprise security. So that as Cloudflare matures its network security, that is additional revenue that will be coming to it as well. So yeah, the future, Cloudflare will become very, very diversified on a revenue basis.
Okay. I think that sums up your thesis as a whole, because you say, yeah, maybe it will find some financial struggles in the short term, but in the long term, it is very well positioned, even from a technology standpoint, right?
Yeah, absolutely.
Okay, so I'm done with the questions. If you have anything else you want to add, feel free to do so. If not, I would want to thank you, Jordan, for your availability and yeah, all this series that we are getting together.
Yeah, great. Thank you, Giacomo. Yeah, so we'll also discuss what we're going to include in the next episode of the cybersecurity series. Yeah, because there's a lot more to talk about.
Okay, so this is it for today. I'm Giacomo. See you next time.